The Federal Reserve finally cut interest rates last Wednesday. For the first rate cut in this cycle, they slashed a whopping 50 basis points. The timing and magnitude were actually anticipated by the market, given the obvious facts of continuous declining inflation and weakening employment. However, the RBA chose to hold this week. When will the RBA follow suit? Are Australian property investors starting to feel hopeful? How does the US entering a rate-cutting cycle affect the Australian economy? Will the Reserve Bank of Australia be forced to kick off its rate-cutting cycle earlier than expected? Once Australia starts cutting rates, will the property market in Sydney and Melbourne be saved? Spoiler alert, Melbourne has a chance to become a winner in the next upward cycle of the property market. Hi, I'm Alex. Welcome to Property Strategy, where I share information about real estate investment, economic trends, and wealth creation. If you like this video, smash the subscribe button and turn on the notification bell to watch new weekly videos. Without further ado, let's get into it. The Fed's decision to lower interest rates signifies that it has joined the major Western countries in the new cycle. The European Union, the UK, Canada, New Zealand, Denmark, Switzerland, and others began their rate-cutting cycle a while ago. This time, the rate cut is quite substantial, a reduction of 0.5%. The US federal funds rate has now decreased from 5.25 to 5.5% to a range of 4.75 to 5%. The Federal Reserve's decision to cut rates this time mainly references two economic indicators: inflation and employment. In the past few years, we have experienced skyrocketing prices. In 2022, the rate of price increases is set a 40-year record high. Even today, the average price level is still 25% higher than before the pandemic. In recent months, we've seen a rapid downward trend in overall inflation. The US core PCE year-over-year in May, June, and July consistently remained at a low of 2.6%. In August, the month-over-month CPI rose by only 0.2%, lowest rate of inflation since 2021. This is all thanks to a 4% decrease in energy prices, including a 10% drop in oil prices and a 10% reduction in used car prices due to increased production capacity of new cars. Therefore, the inflationary pressures in the US were basically eliminated a few months ago, moving sustainably toward the annual inflation target of 2%. The Federal Reserve has long stopped worrying about inflation. The current market conditions have given the Fed plenty of room to cut rates, preventing the overall economy from worsening. Besides inflation, the second major consideration for the Fed's action is the job market. In 1977, the Federal Reserve Act established the Fed's two main responsibilities: ensuring price stability and maximizing employment. Simply put, the Fed will spare no effort to prevent severe inflation and, while controlling inflation, try to delay the rise in unemployment rates as much as possible. According to new data released by the US Bureau of Labor Statistics, the number of job openings decreased for the second consecutive month in July, dropping from 7.91 million in June to 7.67 million. The number of US job positions has fallen to the lowest point since January 2021 during the pandemic. The employment report for August shows that only 99,000 jobs were added, lower than July's downwardly revised 111,000, and well below the market's general expectation of 140,000. Therefore, the cooling of the US job market has become a trend that cannot be reversed in the short term. The decrease in employment indicates that the Fed's high interest rate policy is working, slowing down the economy and reducing inflation. This 50 basis point rate cut precisely shows that the Fed has achieved its goal of cooling the economy. The Federal Reserve expects the unemployment rate to rise to 4.4% by the end of 2024, remain unchanged by the end of 2025, and decrease to 4.3% by the end of 2026. So it seems that the US rate-cutting cycle may last for 2 years. Many people are speculating. Now that the United States has started cutting interest rates, will Australia follow suit? To get straight to the point, yes, it definitely will. The only question is how much of a lag there will be. Like the US, Australia needs to meet two conditions before cutting rates: lower inflation and higher unemployment. Australia needs to control the inflation within the 2 to 3% range. Let's look at the inflation trend. In the second quarter, Australia's trimmed mean CPI year-over-year decreased to 3.9%. In July, year-over-year inflation dropped further to 3.8%. The trend is consistent. Prices in Australia are still rising, but the pace is slowing down. Once these figures get very close to 3%, the Reserve Bank of Australia will have its first reason to cut interest rates. The second condition for the RBA to cut rates is that the unemployment rate exceeds 4.5%. Once it surpasses this level, the RBA must intervene by cutting rates to safeguard Australia's livelihood. According to the latest data released by the Australian Bureau of Statistics last Thursday, the unemployment rate in August remained unchanged at 4.2%, with a slight increase in the number of people unemployed. Combining these two factors, inflation is slowly decreasing, but still some distance from the 2 to 3% target range, and the unemployment rate is stable. We can be pretty certain that the RBA will not cut interest rates until the end of this year. The market expects the RBA to reduce rates by 0.25% in February 2025 and cut another 0.75% before the end of 2025. However, the RBA might still cut rates earlier. For instance, if the US cuts rates and Australia doesn't, Australia's investment return rate will rise relative to the US. The market would then sell off US dollars and buy Australian dollars, leading to an appreciation of the Australian dollar. This would cause the prices of Australian goods and services exports to increase, slowing down Australia's economic growth. If this situation arises, I believe the RBA will face strong pressure from the Australian federal government. Although the RBA is officially an independent institution and shouldn't be influenced, that's just a saying. I don't entirely believe it. If the Australian Treasurer criticizes them publicly every day, and the public opinion also starts to criticize the RBA, I doubt they wouldn't feel any pressure. The starting point of this pressure is when US interest rates began to fall below Australian rates, which the market expects to happen between this December and next January. Now, the topic our channel cares about the most, the US has already cut interest rates. Will the Australian property market rise? When will the Australian property market's upward trend start to accelerate? When will the Sydney and Melbourne property boom finally begin? I want to make it clear that US interest rate cuts have no direct impact on Australian house prices. It's only when Australia begins to cut rates that there will be an uplifting effect on the Australian property market. However, Australian rate cuts do not necessarily mean that house prices will rise. As this chart shows, the relationship between Australia's overall housing market and its interest rates has been sometimes positively correlated and sometimes negatively correlated over the past 20 years, with no consistent pattern. If we overlay the cycles of interest rate increases and decreases onto the rise and fall cycles of the property markets in Australia's 8 major cities, the results become even more irregular. In the same 5-year period, some cities experience price increases while others see declines. So how can we explain this using interest rate fluctuations? It's simply inexplicable. Interest rates are just one factor affecting house prices. A decrease in interest rates means lower borrowing costs. People can borrow more money and naturally afford more expensive homes, giving house prices upward momentum. But ultimately, house prices depend on the balance of supply and demand. Both the supply and demand sides have multiple interacting factors, such as population growth, personal wealth accumulation, government investment in infrastructure, fiscal policies, subsidies, and the pace of housing construction. In many of our previous videos, we've discussed the situation of Melbourne's property market. Currently, Melbourne's overall market is flat and slightly declining. House prices in Melbourne have experienced negative growth for 6 months. Against the backdrop of skyrocketing prices in many other cities, Melbourne's house prices have been surpassed by Brisbane, Perth, and Adelaide, currently ranking third to last among Australia's 8 major cities. It is a bustling metropolis with a population of 7 million, yet its house prices have been overtaken by cities with a population ranging from 400,000 to 2.7 million. Do you feel a sense of disappointment or even despair? Can Melbourne's house prices still rise? Melbourne's house prices have the potential to increase. It's just that the conditions aren't there yet. There are many reasons for the current decline in Melbourne's house prices. For example, the high proportion of apartments in Melbourne is dragging down the overall market. The housing supply is increased under the due pressure of new constructions and the investors offloading properties due to high interest rates. And the Labor government's increased taxes and restrictions on property investors. All these factors are holding back house prices. On the other hand, last year, Victoria's population growth rate was actually 2.7%, which isn't bad. But overall, the demand side of Melbourne's market isn't strong, while the supply side is robust, leading to the current state of the property market. If any of these factors change, Victoria's property market will start to shift. For instance, if the government begins to stimulate the housing market by offering favorable subsidy policies, if the people who originally planned to move to Brisbane, Perth, or Adelaide notice that house prices there have surpassed Melbourne's and decide it's more cost-effective to move to Melbourne instead, accelerating population growth, or if the Labor government is voted out and policies unfavorable to property investors are abolished, all these scenarios are possible. Whether it's the Australian market or the markets of individual cities, All real estate markets have their patterns. In the short term, there are fluctuations, but in the long run, prices always go up. The Melbourne property market performed exceptionally well in the past. This chart compiles average gains and losses in the housing markets of Australian cities from 1980 to 2023. The author has simplified it significantly, making it very easy to observe patterns and trends. According to the data from REIA and Pro Solution, Sydney's average annual house price growth over the past 40 years has been 7.95%. From 1980 to 1988, it experienced an 8-year surge with an annual growth rate of 20.9%. Between 1989 and 1996, it was almost stagnant, with an annual growth of just 0.4%. Then from 1997 to 2004, another surge occurred. From 2005 to 2012, slight growth. From 2013 to 2016, another surge. From 2017 to 2020, slight growth again. And we all know what happened after the pandemic. In fact, the fluctuations in Sydney's property market are much greater than those in Perth. When looking at the chart, there are a few points to keep in mind. When we talk about the average growth rate during a certain period, it doesn't mean the growth rate was the same every year within that period. Each period contains its own mini cycles in the housing market. If you change the starting and ending points of these periods, the annual growth rates will vary. The author selected the starting and ending points based on their own methodology. Due to differences in statistical methods and data sampling, there might be discrepancies in specific growth figures compared to other research institutions, but the overall market trends for each period remain the same. Let's take another look at Melbourne's property market over the past 40 years. From 1980 to 1989, there was a surge with an annual growth rate of 14.4%. From 1990 to 1996, slight growth occurred. From 1997 to 2016, there was an 18-year continuous surge with an annual growth rate of 8.4%, which lasted a very long time. From 2017 to 2021, prices continued to rise with an annual growth rate of 6.7%. After reaching a peak in March 2022, it began to fluctuate downward. Other cities also experienced periods of surges and slight growth. From this chart, we can summarize 3 patterns. Pattern 1. Over the past 40 years, house prices in all cities have been on an upward trajectory. Although there are small cycles of ups and downs, the overall trend of rising prices is certain. Pattern 2. After a period of slight growth, a surge period typically follows. The differences between cities and periods lie only in how much prices increase and the duration of the growth. Pattern 3. Standing at any point in time, we cannot predict the next cycle. For example, if we were in Melbourne in 2000, the market had already been rising for 3 years. If you thought this cycle was about to end and sold your house, you would have missed out on the next 15 years of continuous growth. If you were in Sydney in 2019, where house prices had been flat for 2 years, and you decide to sell, you would have missed the price surge brought by the pandemic a year later. Conversely, if you were in Adelaide in 2009 and continued to hold property, you would have entered the period from 2011 to 2018 where house prices remained flat. No one knows the future. Those who always make money in the Australian property market are the ones who hold properties long-term, spanning multiple cycles. Once you sell because of your personal views on the short-term market, you risk incurring losses, whether it's because you sold your property or missed out on the imminent surge in value. After all this discussion, can you actually buy a property in Melbourne now? Well, it depends on your situation. If you only want to purchase an owner-occupied home, have no other buying needs, and aren't concerned about the short-term appreciation, you can buy now. Since the Melbourne housing market has been flat for a while, it's currently a buyer's market. You might even negotiate a better price. It doesn't matter if you don't make money in the short term. You'll be holding your home for over 15 years. As long as you live comfortably, that's what counts. In the long run, the value will definitely increase. If it appreciates in the short term, even better. If not, it's no big deal. If you aim to buy an owner-occupied home, let it appreciate, and then sell it to upgrade to a bigger house in a better location, you need to consider your timeline for moving. If you hope to upgrade within 2 to 3 years, it's better not to buy in Melbourne right now because property appreciation might not be that fast. It might be wiser to invest in real estate in other states first, make some money, then sell or refinance, and purchase a better owner-occupied home in Melbourne. Of course, I might be wrong about what happens in the market in 2 to 3 years. If you're looking to invest in multiple properties over the long term to achieve financial freedom, this is where the Aus Property Strategy Vision membership can help you. When you're first building an investment portfolio, you need to acquire high-growth properties that appreciate quickly. This allows you to extract equity to buy another one, rapid expanding your investment portfolio. This approach isn't suitable for Melbourne right now because recent price increases haven't been fast enough. Investing in properties in another state is better in the short term. However, if you already own some properties in other states, you might consider adding a Melbourne property to your portfolio because prices will eventually rise. We're currently assisting some well-funded property investors in finding properties in Melbourne. We're focusing on long-term appreciation prospects and current cash flow. If the cash flow holds up, you can simply hold on to the property and wait for the market to boom. Currently, interest rates are relatively high, and with Melbourne's increasing taxes on property investors, long-term rentals generally aren't suitable for this investment strategy. The average gross rental yield in Melbourne is only 3.7%. With an 80% loan, it's undoubtedly negative cash flow. After interest rate cuts begin, cash flow will improve, but it will take longer for Melbourne properties to move out of a negative cash flow situation compared to other states. Therefore, we must find ways to achieve higher rental income now. Oz Property Strategy's solution is to help our Vision members find properties suitable for short-term rentals. As long as the property is decent, you can achieve positive cash flow even before interest rates drop. The short-term rental management network we've established specifically for our members now covers Sydney, Melbourne, Brisbane, Gold Coast, and Perth. And it's also open to non-members. If you made it this far, please give me a thumbs up, subscribe, and share this with your friends. Turn on the notification bell to watch new weekly videos, and have a good one. Bye.